Hello, Mark here from Success with Options. It's June 24th, just about almost a week after the June expiration. We had a nice pullback on the SPY that's brought us down to the short strike, and I wanted to spend a moment going over the platform and talking a little bit about calculating roll values, close values using theoretical value. And we can see the power of time erosion as we look at where we're at with respect to the current expiration cycle and where we'd like it to be in terms of getting our ideal close value. Okay, here we are on the platform, and as we can see, our position is currently still in profit. We made about 25% return if we calculate on a per month basis on our first roll. We sold the spread bought the spread, I'm sorry, for about $1.27 per month, and we closed the first roll for $1.60. Gave us about a 25% return, and we're doing okay. If we look at the position to exit right now, $1.51, we'd like to see that at least be $1.60, even though we're in profit. Kind of an ideal target would be somewhere around 25% or more. What I wanted to do was take a look at some options that we have in terms of analyzing the potential future and where we'd like to see it go and where it could go based on just the fact that time's passing. So with that, I want to go ahead and switch over to the trade tab, and we see that the price right now is currently at 90.21. We've seen a nice pullback Monday and a little bit of a flat movement on Tuesday, and today there's a potential we could see a move up. In fact, we've already seen a little bit of a move up here. So, this could theoretically be an ideal time, but we don't know the future. So, what we'll do is just look at some potential outcomes and see how we can analyze when would be the ideal time to do a close or a roll on a calendar spread. To start with, what I want to do is I want to change the view from single to calendar. And what that allows us to do is to be able to look at the value of 2 months at the same time. In this case, we're currently in a July-August position. And so if we expand this, we currently have a long August 90 and a short July 90. And the current value is trading for around $1.57. One of the columns we've currently got set here, delta and probability of expiring, which doesn't make a lot of sense in a calendar spread because we've got two different positions which would have two different probabilities. But what we could do is change this column to theoretical price. And when we do, we see that a whole new section pops up here. We have the date and the stock price adjustment and a volatility adjustment, which means we can manipulate all of those values together or independently to see what its effect might be on the spread. All right, so let's go ahead and set this value to today's date, and we see that the theoretical value is around $1.62, and that's what we could expect theoretically to close the price at the moment. However, that's based on volatility and a bunch of other numbers that are in play. What I want to do is look at the potential of what would happen if we move forward just a week in time, which would put us on the 1st of July. And we see that just by a week's time passing, but the price not changing, we're currently at a value of $1.72. And if I was to move forward another week, we're now at $1.87. So you see, it's to our advantage to get the price of the option to be priced as close to the expiration date as possible. Although we know it's not going to be ideally where we'd like it to be. In other words, it's not going to be at $90 on the last day of expiration. The odds are pretty low. But our goal is to get as close as we can to expiration and as close as we can to the price that the short strike that we've sold. That would be the ideal scenario. What I want to do is, we've said in the past that our target roll date or our target close date is somewhere between 4 to 7 days before expiration. I typically like to start looking at a roll about the last week if I can, although I have been known to close a roll before that if the price is optimum. So we can't really be stuck on a particular rule like 4 to 7 days if we're getting a decent roll at a different time. So if on the 13th, for example, I was to be able to get a $2 roll or a $1.90 roll, or close, then I would probably take that because that's a really decent profit. So we're always kind of balancing those things. But essentially, we need to have a framework of rules that allow us to make good decisions and to be able to follow a consistent pattern. So I typically look at my target date as about the Monday before expiration. So in this case, I would pick the 13th, and as we see, the price jumps to $2.09. So if the price did not change at all between now and the 13th, then we could expect to see the spread increase to $2.07, and that's what we could close. And that would actually be a really decent trade. What we want to do is be constantly evaluating, probably every few days as we look at the price movement and time passage, we want to be able to go in and take a look at that spread, and we want to look at what's the close value, what's the roll value. And a calendar spread is kind of a tricky thing in the sense that you can't just go in knowing what the price is going to be. So it's always a bit of a balance between what is your target profit that you're looking for, and not wanting to exit out too soon because you've got some profit. Calendar spreads, the odds are probably, in terms of the ideal strike, they're not as good as some other trades like a vertical spread or an iron condor. So, but they have a decent return when they are correct, and they have a pretty wide tolerance for being wrong and still yielding some kind of return. So we want to balance all those things as we're kind of looking at our spread, and when we get to the point, like my rule is typically something like if I can lock in about 30% of profit at any point in time, 30 to 40%, I'll go ahead and do that. If I can lock in 30 to 40% on a roll, I'll go ahead and do the roll, whether I'm at 10 days or 4 days or whatever. So those are the kind of things we need to have in mind. We need to have a framework in our rules that say, I will roll on this condition. I will exit on this condition with a certain target profit. So those are the kind of things we want to look at. I just wanted to toss out an opportunity to do an evaluation, since we were almost at what I would consider an ideal close price or an ideal roll price. But in this particular case, there's just too much time between now and expiration. And one other thing I wanted to take a look at, and we'll see why this is right here. So the thing is that we are currently not in the money on either position. We are about 34 cents out of the money on our put position. We see that for the August position, it's worth $3.80, but there's still $2.27 worth of value in the July position. So what we'd like to see happen is that we'd like to see all of that value melt away, which it will over the course of the next month. It will melt away much faster than the value of the August position. And so we will be left with a position, as we said, if time goes on and price doesn't move, we'll be left with a position that widens out to about $2 in value. If we can see that happen in the 4 to 7 day time frame, then certainly I'm going to take that profit. In fact, if I see anything above $1.60, $1.60, $1.70 in the value of the close, I'm probably going to take it because that's a really decent return. That would put us at about 27 to 30% return on the second roll, and that's a decent return on any trade. So those are the kinds of things that we're looking for. I hope you found this video helpful. What you've just seen is an overview of calendar spreads as a trading strategy and an example of trading them. Successful options trading is not just a matter of knowing how to construct a trade or how to enter or exit the trade. Successful options trading is built around a trading system that includes a trading plan with rules for selecting the stock or ETF, rules for selecting the options, rules for entry and exit, and rules for money management. These elements help produce consistency, and that is the #1 attribute of a successful options trader. For more information on options strategies, building an options trading system, or options broker reviews, and more, please visit www.successwithoptions.com. Thanks and happy trading.